Good afternoon, students. Today we would take the concept of business economics and financial analysis by Dr. Neetu Sachdeva, Associate Professor at KG Reddy College of Engineering and Technology. Today's topic would be on break-even analysis. Now, before beginning this break-even analysis, let's talk about what is cost. Cost. Total amount can be utilized to converting material. Material is the input into the finished product, which is the output. So the conversion of input to the output is called as cost. So total amount can be utilized to converting material into the finished goods is called cost. Now, basically in any company, we have two types of cost. All the cost in the company can be divided into two types. One is the fixed cost, the second is the variable cost. To begin with, fixed cost. Fixed costs are the costs which do not vary or which does not change with the volume of production. That means this is the cost which in total does not vary or change, incorporate. Fixed costs are associated with the very existence of the firm's plant and therefore must be paid even if the firm's rate of output is zero. Whether we produce or we do not produce, whether we produce 0 units or n number of units, we need to pay the fixed cost. For example, interest on borrowed capital, rental payments, a portion of depreciation, changes on equipments and buildings. So these are the examples of the fixed cost. Next we have is variable cost. On the other hand, variable costs are those costs which changes with the volume of production. If we increase the production, our cost increases. If we decrease the production, the cost decreases. They include payments of raw material, for example, changes in fuel, electricity, wages and salaries of temporary staff, depreciation charges for the production. Production is increased, the cost also increases. If production decreases, the variable cost also decreases. So the complete cost can be divided only into fixed cost and variable cost. Now, can we have an examples of what is a fixed cost? Well, perfect. Let's go ahead with what is break-even analysis. Break-even analysis is a technique of profit planning. It is essentially a device for integrating cost, revenue, and output of the firm in order to illustrate the probable effects of alternative course of actions upon net profits. Basically, it is the point where we have no profit, no loss. The break-even point is defined as the one where profit is equal to zero. Hence, we can sum it up as total revenue equals our total cost. The zone of break-even point is called as no profit, no loss. So let's revise once again, where break-even analysis is also called as CVP analysis, which is cost volume profit analysis. The break-even point can be defined as that level of sales at which total revenue equals your total cost and the net income is equal to zero. This is also known as no profit, no loss zone. Profit break-even analysis refers to analysis of cost and their possible impact on revenues, volume of the firm. Hence, it is also called as CVP analysis, which is cost, volume, profit analysis. A firm is said to attain the BEP, which is break-even point, when its total revenue is equal to your total cost. The main objective of break-even analysis is not only to spot the break-even point, but also to develop an understanding of the relationship of cost, volume, and price within a company's practical range of operations. So we have few assumptions if we have to calculate our break-even analysis. The assumptions are the behavior of cost and revenue of the firm remains linear. Sales price remain constant. Cost of production remains unchanged. We cannot change either the sales or cost of production. Volume of output is the only relevant factor affecting the cost. As I told you before, cost can only be divided in the company into fixed and variable costs. So these are the assumptions. Based on these assumptions only, we can analyze our break-even point. Now, let's have a graphical representation. The graphical representation is, towards x-axis we have the production, towards the y-axis we have C by P, which is cost by profit analysis. Initially, there's a parallel line, if you see, towards the x-axis, which is called as total fixed cost, TFC, which is your total fixed cost. So later we have a line, we have towards the x-axis, if you see, after the fixed cost we have a total variable cost, which is TVC, which is total variable cost. Total fixed cost and total variable cost are your total costs there. The point at which your total cost, and if you see the total revenue cost, it starts from zero. Your total revenue starts from zero. You produce one unit, you sell the same one unit profit, which is, or the cost incurred to manufacture that particular unit. So that way we have the total revenue line starting from the zero. The point at which your total revenue is meeting your total cost is called as BEP, which is break-even point. The point at which total revenue is equal to your total variable cost. Above this point, it is always the profit. Below the point of break-even point, it is always the losses. The point at which there is BEP, which is break-even point, it is no profit, no loss. Ahead of break-even point, it is always the profits. Less than break-even point, it is always the losses. Now, moving further, how do we calculate the break-even point? The formulas to calculate the break-even point is basically sales minus all your cost. Cost can be variable cost and fixed cost. Sales minus cost is equals to profit. So it is either of it is called as contribution, either sales minus variable cost or fixed cost plus profit. Both are called as contribution. Any part of it which is given in your problem, you can just take that particular data based on your contribution, either sales minus variable cost or fixed cost plus profit. Next, how do we calculate our profit volume ratio, which is PV ratio, which is in terms of units. If you have to calculate, we should use contribution per unit by selling price per unit, which is contribution per unit can be, say, selling price per unit minus variable cost per unit. You will get contribution per unit divided by selling price per unit. Or in case you have 2 years data to calculate PV ratio, we can use change in profit by change in sales into 100. Current year and previous year changes you can just see in terms of profits and sales into 100. You can calculate your PV ratio. Now, what is exactly the break-even point? How do we calculate BEP in units? The formula to calculate BEP in units is fixed cost divided by selling price per unit minus variable cost per unit. So fixed cost by contribution also, which the selling price per unit minus your variable cost per unit is also called as contribution. Hence, fixed cost divided by contribution also can be break-even point. Next, based on the information given in your problem, you can even use break-even point is equals to fixed cost by PV ratio. In case in the problem, if you have solved already the PV ratio, you can directly jump on to this calculation of BEP, where you can directly calculate your BEP using fixed cost by PV ratio. So that way we calculate in units and then also in sales. Next, how do we calculate margin of safety? Now, what is margin of safety? Margin of safety is difference between actual sales and sales at break-even point, BEP. The relationship between profit and profit volume ratio, it is called as margin of safety. The formula is net profit divided by profit volume ratio. Margin of safety is equals to actual sales minus sales at break-even point. Thank you.